For thousands of years, societies have trusted money not because it was flawless, but because it was believed to be stable, controlled, and limited. Every major monetary collapse in history began quietly at the moment when confidence replaced discipline and belief replaced restraint. Civilizations do not collapse when people panic, but when people remain confident while underlying systems decay. History shows that monetary failure arrives slowly, disguised as normalcy, before revealing itself through sudden loss of purchasing power. In 1914, the world entered World War I with currencies anchored to gold and exited with paper claims backed by government debt. That transformation permanently altered how nations financed survival, shifting money from a measure of value into an instrument of policy. Once money became a political tool rather than an economic anchor, its limits became flexible. The consequences of that flexibility did not appear immediately, but they accumulated silently over decades. Every generation assumes its financial system is more advanced, more complex, and therefore immune to historical outcomes. Yet complexity has never eliminated limits. It has only delayed recognition of them. Gold repeatedly disappears during periods of confidence because trust makes it unnecessary. It returns only when credibility must be recalculated and promises must be measured rather than believed. In 1933, Americans were told that surrendering gold would stabilize the economy and protect the financial system. In reality, the decision revealed that trust in paper money had already weakened beyond repair. When governments restrict gold ownership, it is never because gold has failed. It is because confidence in currency enforcement has already begun to fracture. In 1971, the world accepted a monetary experiment that removed restraint entirely from global currencies. The decision did not cause immediate collapse, but it quietly removed the final limit on debt expansion. Collapse rarely begins with the language of collapse. It begins with reassurance, confidence, and repeated claims that this time is different. By 2008, global debt had grown too large to unwind naturally without systemic damage. Emergency intervention became permanent architecture rather than temporary relief. Trillions of dollars were created without direct public consent or debate. Stability was preserved on the surface, but discipline was never restored beneath it. Gold did not surge overnight during this period because panic was not immediate. It waited patiently as distortions accumulated and trust eroded gradually. This documentary is not about fear, speculation, or prediction. It is about understanding why history repeats when monetary discipline disappears. Gold's return is not ideology, nostalgia, or rebellion against progress. It is evidence that trust has reached its limit. To understand why gold always returns after collapse, the mechanism behind monetary failure must be understood first. That mechanism has repeated across centuries with uncomfortable consistency. Modern monetary systems are built not on tangible wealth, but entirely on confidence and collective belief. Their strength depends on the faith that governments will maintain fiscal discipline, central banks will restrain money supply, and credit expansion will not outpace real economic productivity. When trust begins to fray, money's value erodes quietly before anyone notices. Governments borrow not only to finance emergencies, but to postpone difficult choices that might provoke public resistance. Central banks facilitate this borrowing by keeping interest rates artificially low, creating the appearance that debt is sustainable while systemic risk quietly grows beneath the surface. When sovereign debt expands faster than the real economy can support, repayment becomes mathematically impossible without further currency creation. Inflation, then, is not accidental. It is a natural consequence of substituting real growth with debt and monetary expansion, gradually undermining purchasing power. Inflation rarely appears immediately because new money first flows into asset markets rather than consumer goods. Equities, bonds, and real estate absorb excess currency, creating an illusion of stability while the underlying economy is quietly devalued. This lag creates a false sense of security for policymakers and the public. By the time consumer prices accelerate, structural imbalances have already embedded themselves across the financial system, making reversal difficult without triggering crisis. Central banks eventually face an impossible choice. Raising interest rates threatens the solvency of governments and banks alike, while keeping rates low continues to erode currency credibility, guaranteeing that real purchasing power declines over time. Historically, governments prefer to manage debt through inflation rather than default, distributing losses quietly across the population. Savers are penalized, debtors benefit, and the financial system retains the appearance of stability, even as underlying risks accumulate. As confidence erodes, economic behavior shifts. Individuals and institutions begin preserving capital rather than investing in growth, redirecting funds into safer, tangible assets that cannot be manipulated or inflated away. Money ceases to serve as a reliable store of value. Gold historically emerges as a consistent alternative, not because of speculation, but because it functions independently of credit, promises, and political control. Gold's supply is limited and grows slowly, making it resistant to manipulation or policy intervention. Unlike fiat currencies, which governments can expand at will, Gold's scarcity preserves relative value during periods of systemic stress. This independence is critical. During periods of monetary imbalance, gold does not react to sentiment, government statements, or temporary market fluctuations. It reacts to the erosion of trust and the collapse of fiscal discipline. Attempts to suppress or control gold often indicate deeper systemic fear rather than strength. Legal restrictions, confiscations, or price controls are almost always symptomatic of governments trying to retain control while underlying confidence has already weakened. Monetary systems rarely fail overnight. They decay gradually and reset suddenly. Gold, in contrast, bridges the gap between decay and reset, providing continuity and preserving value where credit fails. This recurring pattern has appeared throughout history, across continents and under every political system. Geography, ideology, or technology cannot escape the arithmetic of debt, credit, and trust. Every monetary crisis follows the same sequence. Debt expands, confidence erodes, currency loses credibility, and gold reasserts its role as a safe store of value. Understanding this pattern is key to interpreting past collapses and assessing modern financial stability. After World War I, Germany faced an unprecedented financial and political crisis that set the stage for hyperinflation. The Treaty of Versailles imposed reparations of 132 billion gold marks, a sum far beyond the nation's productive capacity, forcing policymakers to rely on rapid monetary expansion to meet obligations. Between 1919 and 1923, the Reichsbank flooded the economy with marks, attempting to cover debts and stabilize the government. This excessive printing far outpaced economic output, eroding the value of savings and destabilizing wages long before prices fully reflected the inflationary pressures. By 1921, early signs of inflation were visible in markets and daily life, though the government still projected confidence. Citizens observed subtle price rises and increasing money circulation, while the authorities insisted the currency remained sound, masking the growing structural imbalance. By 1923, the German mark had lost nearly all of its value, reaching exchange rates of 4.2 trillion marks to the US dollar. Everyday goods became unaffordable, pensions and savings evaporated, and ordinary transactions required wheelbarrows of cash, demonstrating the full consequences of unrestrained monetary expansion. Workers were often paid twice a day to spend wages before they became worthless. Businesses struggled to operate in a currency that depreciated hourly, and social trust in both financial institutions and government collapsed. Throughout the crisis, gold retained relative purchasing power despite official restrictions and scarcity. A single gold coin could still purchase essentials such as food, clothing, and shelter, illustrating why gold historically serves as a safe harbor during systemic monetary failure. The German government eventually introduced the Rentenmark in late 1923, which was tied to tangible assets like land to stabilize the economy. This reform effectively reset the monetary system, rendering the old marks worthless overnight and proving that disciplined backing could restore trust where it had been lost. Germany's collapse was not an isolated case. Britain abandoned the gold standard in 1931 after facing unsustainable debt and trade imbalances, immediately causing the pound to devalue while gold priced in pounds surged in value. In 1933, the United States confiscated private gold and subsequently devalued the dollar in 1934 from $20.67 to $35 per ounce, reflecting a 41% loss in purchasing power. These measures did not create gold's value. They confirmed that confidence in paper currency had already eroded. After World War II, the Bretton Woods system attempted global monetary stability by pegging currencies to the US dollar and the dollar to gold. Yet by the late 1960s, deficits and war spending pushed US debt beyond gold reserves, straining the system and forcing foreign governments to redeem dollars for gold. In August 1971, President Nixon closed the gold window, permanently ending dollar convertibility and fully embracing fiat currency. This action removed the final restraint on global money creation, setting the stage for decades of inflation and volatile purchasing power. Throughout the 1970s, U.S. inflation surged to over 13% annually by 1980, while gold prices rose from $35 to over $800 per ounce. Gold did not cause the crisis. It merely reflected the loss of monetary discipline and confidence. Every historical reset, from Weimar Germany to Bretton Woods, demonstrates the same recurring mechanism. Debt expands beyond productive capacity. Confidence erodes, currency loses credibility, and gold reasserts its role as a safe store of value. This case study proves that gold's return is mechanical, not speculative. It responds to structural monetary imbalances rather than government policy announcements, reaffirming the pattern that underlies every major collapse. The 2008 global financial crisis marked a turning point for modern monetary systems, exposing structural vulnerabilities on a scale unseen since the Great Depression. Central banks around the world abandoned traditional limits on debt and money creation, pushing interest rates towards zero and implementing quantitative easing to prevent systemic collapse. The U.S. Federal Reserve expanded its balance sheet from less than $900 billion in 2007 to over $4.5 trillion by 2015, creating trillions of dollars digitally to stabilize markets. While these interventions prevented immediate collapse, they also masked underlying imbalances, allowing debt to accumulate faster than economic output. Europe followed a similar path through the European Central Bank, purchasing sovereign bonds to suppress borrowing costs and prevent defaults. Nations like Italy, Spain, and Greece relied heavily on ECB support to finance deficits that would otherwise have been unsustainable, illustrating how policy replaced market discipline. Japan had pioneered this approach decades earlier, maintaining near zero interest rates and expanding its central bank holdings of government debt since the 1990s. By 2010, the Bank of Japan owned a substantial portion of its national debt, demonstrating how monetary expansion can stabilize a system while simultaneously creating structural risk. These policies stabilized markets but did not reduce debt. They only allowed governments to delay the consequences of borrowing beyond productive capacity. By 2019, global sovereign debt had exceeded $250 trillion, far surpassing historical limits, yet systemic risk remained hidden beneath apparent stability. The COVID-19 pandemic accelerated this process dramatically, forcing governments to borrow at levels comparable to wartime while stimulating economies with unprecedented monetary creation. Trillions of dollars were injected into the financial system globally, temporarily sustaining confidence even as underlying imbalances deepened. Inflation initially appeared muted due to supply disruptions and suppressed demand, giving policymakers and the public a false sense of security. By 2021, however, prices surged across food, energy, and housing, revealing that trust in monetary discipline had begun eroding. Central banks responded with interest rate hikes, but these adjustments immediately stressed banking systems and government budgets, illustrating the fragile balance between debt, rates, and confidence. Several regional banks failed in 2023 after holding long-duration bonds purchased at artificially low yields, necessitating emergency liquidity interventions. Even with rate hikes, real interest rates remained negative for extended periods, penalizing savers while benefiting debtors. This created an environment where purchasing power continued to erode, despite the illusion of stability in financial markets. Meanwhile, central banks became net buyers of gold, with official reserves rising steadily from 2010 onward. China, Russia, and other emerging economies increased holdings to reduce dependence on the US dollar and safeguard against potential currency instability. Gold accumulation accelerated further after sanctions, and geopolitical tensions highlighted vulnerabilities in reserve asset management. Countries realized that assets outside the political influence of other nations provided strategic protection, reinforcing gold's historical role as a safe haven. Despite market calm, structural risk grew beneath the surface. Volatility was suppressed through intervention, but the balance between debt, currency credibility, and trust continued to deteriorate. Gold prices rose gradually rather than explosively during this period, reflecting a slow erosion of confidence rather than panic. The rise was mechanical, not speculative, confirming historical patterns observed in past monetary crises. No modern collapse has yet occurred, but the system has been stretched farther than at any point in history. History teaches that such stretching does not remove limits. It only postpones their inevitable reassertion. Every monetary imbalance eventually forces an adjustment. When trust in currency declines, gold historically reappears as a measure of real value, bridging the gap between decay and reset. When debt reaches a point where repayment through growth alone is impossible, governments face a narrowing set of policy options. They can default, impose austerity, or pursue inflation, with inflation historically emerging as the preferred path because it spreads losses across the population quietly and gradually. Inflation erodes purchasing power unevenly, hitting savers and fixed-income earners hardest while benefiting debtors and governments. Social trust begins to fray as ordinary citizens recognize that their money no longer holds the same value, and long-term planning becomes increasingly difficult. Banking systems face mounting stress when inflation coincides with rising interest rates. Asset values decline while liabilities remain fixed, exposing balance sheet fragility and requiring emergency liquidity interventions to prevent immediate collapse. Governments often respond with financial repression, quietly redirecting capital into government bonds and restricting access to safer alternatives. Interest rates may remain below inflation for extended periods, reducing the real burden of debt while penalizing savings, further eroding trust in the currency. Currency depreciation becomes almost inevitable, making imports more expensive and spreading inflation across the economy. Individuals and businesses adjust defensively, hoarding tangible assets and preserving wealth in instruments not easily manipulated by policy, reinforcing gold's role as a reliable store of value. Social and political tensions rise as citizens lose confidence in institutions to maintain monetary discipline. Long-term investments are postponed or abandoned, replaced by short-term strategies designed solely to preserve capital against an eroding currency. Gold responds mechanically to this environment, independent of politics, speculation, or sentiment. Its rise signals that the underlying credibility of currency has weakened, acting as an early warning before official crises are acknowledged. Currency systems rarely collapse instantly. They fade gradually, losing reliability until a formal reset is unavoidable. Volatility appears sporadically, but underlying imbalances continue to grow, creating a slow-motion financial crisis that can last years. This process is not dramatic in the sense of immediate chaos. It is subtle, structural, and persistent, demonstrating that modern economies can survive extended periods of imbalance before reset occurs. Gold does not cause these adjustments, nor does it prevent them. It exists as a constant measuring and preserving value, while monetary systems experiment with policy and delay inevitable corrections. The implication is clear. Systemic adjustment is unavoidable when debt and currency credibility diverge. History shows that gold will always reemerge as a reliable measure, bridging the period between collapse and monetary reset. Understanding this pattern allows policymakers, investors, and the public to anticipate structural risk rather than react to panic. It reframes economic crises not as sudden disasters, but as predictable phases of monetary evolution. Every major monetary system, past and present, eventually encounters this moment of truth. Gold's persistent return after collapse is the clearest indicator of that universal economic mechanism at work. Gold does not predict monetary collapse, and it does not prevent it, yet it always records the moment when fiscal discipline gives way to necessity. Across centuries, every civilization that overstretched debt or abandoned currency restraint has seen gold quietly return as a measure of lost trust and value. Gold disappears when confidence in money is high, only to reemerge when credibility is questioned or lost entirely. Its return is mechanical, reflecting the arithmetic of debt and the collapse of trust, rather than any speculative behavior or government policy. Modern financial systems often dismiss gold as obsolete, considering it an anachronism in a world of digital money, derivatives, and complex banking systems. History, however, demonstrates that this apparent obsolescence is precisely why gold survives every collapse and continues to preserve value across generations. Gold cannot be created by decree, printed digitally, or manipulated to suit policy goals, making it resistant to the forces that erode paper money. Its scarcity, universality, and independence from any single government ensure that it remains a benchmark of true economic stability when all else fails. Every monetary system eventually faces the same reckoning. Debt outpaces productivity, trust erodes, and currency credibility declines. In each instance, gold reasserts its role, bridging the gap between decay and systemic reset, and preserving wealth where paper money cannot. History has already answered the most pressing question about financial collapse. What remains when promises fail, confidence disappears, and monetary systems are tested? Gold always returns, reliably and predictably, offering a tangible measure of true value amidst chaos. This insight reframes modern economics, revealing that monetary systems are not invincible, but that long-term patterns persist regardless of technological advancement, policy sophistication, or global scale. Gold's resilience is not speculation. It is proof that certain economic truths are universal, constant, and unavoidable. For policymakers, investors, and citizens alike, understanding this principle allows preparation rather than panic. It emphasizes that financial crises follow rules, not randomness, and that the most durable form of wealth historically lies beyond the reach of policy manipulation. In conclusion, gold does not fail because it is superior. It survives because it is independent, scarce, and universally recognized. Every financial collapse across history reinforces the same lesson. When trust in money erodes, gold quietly returns to preserve what paper promises cannot.